You think you need a fortune to build a fortune. But what if I told you that having just $500 might be the single greatest competitive advantage you'll ever possess in your entire investing life, and you're about to waste it by doing what the institutions do instead of exploiting the mathematical opportunities they physically cannot access? In the next few minutes, I'm going to walk you through these asymmetric market principles that separate extraordinary wealth builders from everyone else trapped in conventional thinking. And if you stay with me until the end, you'll discover exactly how to turn small capital into substantial returns by accessing opportunities that are mathematically impossible for large investors to exploit. So before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from, because what I'm about to share with you represents 40 years of economic research and real-world investing experience that most people never discover until it's already too late. The mathematical truth about small capital that Wall Street desperately hides from you. Listen, I need you to understand something fundamental that's going to change everything about how you think about investing for the rest of your life. In 1962, I was consulting with a small manufacturing firm in Chicago. Nothing fancy, just a basic metals fabrication shop. And the owner, a man named Walter, asked me to look at his balance sheet because he was worried about competition from larger companies. He had about $50,000 in working capital, maybe 12 employees, and he was convinced he was doomed because bigger competitors had millions to spend on new equipment and marketing. I looked at his numbers for about 20 minutes, and then I told him something that made him think I was crazy. I said, "Walter, your size isn't your weakness. It's your greatest competitive advantage. And if you understand what I'm about to explain, you'll be wealthier than most of those big competitors within a decade." He didn't believe me. But 10 years later, Walter sold that little company for $2.3 million, 46 times what he had in working capital when we first met. Not because he got lucky, not because market conditions happened to favor him, but because he understood a fundamental principle of economics that most people completely miss. Here's what I explained to Walter, and here's what I need you to burn into your brain right now. There's an inverse relationship between capital size and return opportunity that's as reliable as any economic law I've ever studied. As your capital base grows larger, your universe of profitable opportunities shrinks dramatically, not because fewer opportunities exist, but because fewer opportunities can meaningfully absorb your capital at scale. When you're managing $500 or $5,000 or even $50,000, you can access thousands upon thousands of investment opportunities that generate spectacular returns, opportunities that completely disappear once you're managing $5 million or $50 million. This isn't theory. This isn't speculation. This is mathematical reality. The largest investment firms in America, the ones managing billions, they operate in what I call the efficient market zone. Every opportunity they can access is simultaneously being evaluated by hundreds of other professional analysts, thousands of institutional investors, and millions of individual traders. Prices in this zone are remarkably efficient because there's constant competitive pressure correcting any mispricings. When Goldman Sachs finds a good investment, so do 50 other firms within hours, and the competition eliminates excess returns almost immediately. But here's where it gets fascinating. Below a certain capital threshold, usually around $10 million in total opportunity size, institutional investors simply cannot participate. It's not that they don't want to, they physically cannot make it work. A fund managing $2 billion needs to deploy capital in chunks large enough to move their portfolio needle, which means they need opportunities that can absorb at least $50 million to $100 million. Anything smaller is literally worthless to them, not because the returns are bad, but because the absolute dollar returns don't matter when divided across their massive capital base. This creates what I call permanently inefficient market segments, entire categories of investments that stay mispriced for months or years because there's nobody with serious institutional capital to correct the pricing. And this, my friends, this is where you build wealth with small amounts of money. You're not competing against Harvard's endowment or Berkshire Hathaway or Fidelity's mutual funds. You're operating in spaces where those giants literally cannot follow you, which means you can find genuine bargains that persist long enough for you to act on them. I've spent my entire career studying market efficiency, and I can tell you with absolute certainty, the smaller your capital base, the higher your potential returns, assuming you know where to look and what to look for. The question that destroys most small investors, the question that keeps them trapped in mediocrity forever, is this: should I even bother investing such a small amount, or should I just wait until I have more money? And I want to address this question directly and forcefully because the answer determines everything about your financial future. Waiting to invest until you have enough money is the single most expensive mistake you can make. Every month you wait, you're not just delaying returns, you're permanently losing the compound growth on that capital. If you invest $500 today at 50 annual returns, which is absolutely achievable in inefficient market segments, in 10 years you have $28,900. If you wait 5 years to invest that same $500, thinking you need to save up more first, you end up with only $3,800 in the remaining 5 years. You've lost $25,000 by waiting. But here's the even more critical point that most people miss entirely. The habits, skills, discipline, and expertise you develop by investing small amounts cannot be purchased or shortcut when you finally have larger amounts. The investor who starts with $500 and makes mistakes on a small scale learns lessons that cost them hundreds of dollars. The investor who waits until they have $50,000 and then makes the same mistakes learns lessons that cost them thousands or tens of thousands. Start small, make your mistakes on small money, develop genuine expertise gradually, and then scale up as your skill increases. This is how every successful investor in history has built their career. Now, let me give you a specific example from my own experience that illustrates exactly what I'm talking about. In 1964, I was consulting with several small businesses while teaching at the University of Chicago, and I noticed something fascinating. There was a small printing company on the South Side that did specialized commercial work for local businesses. Nothing fancy, just high-quality printing of business forms, letterheads, and promotional materials. The owner was 68 years old and wanted to retire. He had no children interested in the business. He was asking $15,000 for the entire operation, which included all the equipment, customer relationships, and the business name. I looked at the financials, and this company was generating about $8,000 per year in pure profit after paying all expenses and a manager's salary. That's a 53% annual return on a $15,000 investment, completely passive once you hired competent management. But here's the critical point. No bank would finance this purchase because it was too small. No investment firm would look at it because $15,000 wasn't worth their time to analyze. No venture capital existed for businesses this size. The only people who could buy this business were individuals with $15,000 in personal savings willing to take the risk. I told 3 of my graduate students about this opportunity. 2 of them said, "That's interesting, but $15,000 is all the money I have in the world. I should probably keep it in savings bonds where it's safe." One student, a young man named Robert, borrowed $5,000 from his father, combined it with his own $10,000 in savings, bought the business, and hired the retiring owner to stay on for 6 months to train a new manager. 10 years later, Robert sold that business for $180,000. He had turned $10,000 of his own money into his share of a business worth 12 times his initial investment, generating passive income the entire time. That opportunity existed purely because it was too small for institutional investors. And Robert seized it precisely because he understood that small capital can access opportunities unavailable to large capital. This is the mindset shift I need you to make right now. Stop thinking of your small capital amount as a disadvantage and start seeing it as your access ticket to opportunities that billionaires are permanently locked out of. Why concentration beats diversification when you're building wealth from small amounts. Let me tell you about a conversation I had in 1978 that completely changed how I think about portfolio construction for small investors. Because this principle alone, if you understand and implement it correctly, will determine whether you build serious wealth or stay trapped in mediocrity forever. I was giving a lecture at Stanford University on monetary policy, and during the Q&A session, a young economics student raised his hand and asked, "Professor Friedman, I've saved $3,000 from my part-time job, and my advisor told me I should invest it across at least 15 different stocks to be properly diversified and reduce my risk. But if I divide $3,000 by 15 stocks, I'm putting $200 into each company. Even if one of those stocks triples, I'll only make $400 profit. That doesn't seem like enough to matter. What should I do?" The entire auditorium went silent because everyone was thinking the same thing, but nobody had the courage to ask it out loud. And I answered him with something that made several finance professors in the audience visibly uncomfortable. I said, "Your advisor is giving you advice designed for a $10 million pension fund trying to preserve capital for retirees, not advice designed for a young man trying to build wealth from $3,000. If you follow that diversification advice, you'll guarantee that nothing you do will ever matter enough to change your financial life." Here's the truth about diversification that the financial services industry doesn't want you to understand, because understanding it correctly would eliminate most of their business model. Diversification is a risk management tool designed to protect accumulated wealth, not build wealth from small amounts. When you already have $5 million and your goal is to preserve that capital and generate steady income while avoiding catastrophic losses, diversification makes perfect sense. Spread your $5 million across 40 different investments, and even if a few fail completely, you'll be fine because the others will compensate. But when you have $3,000 and your goal isn't preservation but multiplication, when you need to turn that $3,000 into $30,000 or $300,000 to achieve financial independence, diversification becomes your enemy, not your friend. Spreading $3,000 across 15 investments guarantees that nothing you do can possibly move the needle significantly. You've created what I sarcastically call diversification. You've taken your limited capital and ensured it cannot generate meaningful returns. Now here's where most people panic and say, "But Milton, if I concentrate my money in just one or two investments, what if I'm wrong? What if those investments fail? I'll lose everything." This is a legitimate concern, and I want to address it directly and carefully because the answer determines everything about how you should invest small amounts. The key insight is this: concentration is only dangerous when you're concentrating in things you don't understand, when you're making random bets, when you're speculating on tips and trends and hoping you get lucky. But concentration becomes extraordinarily safe when you concentrate in opportunities you understand completely, where you've done serious analytical work, where you have genuine informational or analytical advantage over other investors. Let me give you a specific example that makes this concrete. In 1956, I was analyzing the used car market in Chicago as part of a research project on information asymmetry, a concept that became part of George Akerlof's Market for Lemons paper years later. During this research, I met a young man named Thomas, who had started a small used car dealership with $2,500 in capital. Most used car dealers at that time bought inventory randomly from auctions and wholesalers, whatever they could get cheaply, and hoped to resell it quickly at a profit. Thomas did something completely different that illustrates the principle of intelligent concentration perfectly. He decided he would only buy one specific type of vehicle, Ford pickup trucks manufactured between 1950 and 1953, in good mechanical condition. That's it. No cars, no other truck brands, no newer or older models. Just that one specific narrow category. For 2 years, Thomas studied everything about those specific Ford trucks. He knew every mechanical issue they commonly developed. He knew which engine types were reliable and which had problems. He knew the fair market value for every configuration and option package. He knew which parts were expensive to replace and which were cheap. He knew exactly what to look for during inspection to identify problems before purchase. He became the absolute world expert on 1950-1953 Ford pickup trucks in the Chicago market. When Thomas went to auctions or evaluated trade-ins, he could immediately identify good deals that other dealers missed because he had specialized expertise they didn't have. He could buy trucks at below-market prices because he could evaluate condition and value faster and more accurately than anyone else. He could sell trucks at premium prices because his reputation for quality in that specific category attracted buyers. And here's the critical point about concentration and safety. Because Thomas concentrated his entire business in one narrow category he understood completely, he was actually much safer than dealers who diversified across many vehicle types they knew less about. His failure rate on purchases was under 5% compared to industry average failure rates of 30% or higher. Over 5 years, Thomas turned that initial $2,500 into a business worth over $100,000, not through diversification, but through radical concentration in an area where he developed genuine expertise. This is the model you should follow with small capital. Don't spread yourself across 20 different stocks in 20 different industries that you know almost nothing about. Choose one narrow area, one specific industry, one type of asset, one category of opportunity, and become genuinely expert in that specific area. Then concentrate your capital in your absolute best opportunities within that narrow domain where you have real expertise. The mathematics of concentration versus diversification are actually straightforward once you understand them clearly. Let's say you have $5,000, and over 5 years you identify 5 good investment opportunities where you have genuine conviction after doing serious analytical work. If you diversify equally and put $1,000 into each of the 5 opportunities, and 3 of them double while one increases 50 and one goes to 0, you end up with $7,500 total. That's a 50% total return over 5 years, which sounds decent until you calculate it's only about 8.4% annualized. That won't get you to financial independence. But now let's run a different scenario using intelligent concentration. What if you put $2,500, half your capital, into your single best idea, the one you understood most deeply after doing the most analytical work? And let's say that one opportunity doubled, which is realistic if it was truly your best idea. Now you have $7,500 just from that one investment alone, and you still have your other $2,500 working. If you do this consistently, concentrating heavily in your absolute best ideas after doing genuine analytical work, you can generate compound returns that are mathematically impossible with broad diversification across many mediocre ideas. Here's where most people make the critical error in thinking about concentration risk. They assume that concentration equals gambling, that putting 50% of your capital into one investment is inherently reckless regardless of what that investment is. This is completely backwards. The riskiness of concentration depends entirely on the quality of your analysis and the degree of your understanding, not on the percentage of capital you allocate. Putting 2% of your capital into a speculative stock you know nothing about because your brother-in-law gave you a tip is far riskier than putting 50% of your capital into a business you've studied for 6 months that you understand completely. The first is gambling disguised as diversification. The second is intelligent. Concentration based on genuine expertise. Let me give you another specific example from my research that illustrates this point perfectly. In the early 1970s, I was studying small business formation patterns, and I interviewed a woman named Margaret, who had started a small commercial cleaning business in Los Angeles. She had saved $8,000 working as a secretary, and she faced a critical decision. Should she use that $8,000 to start one cleaning business that she would personally manage and operate, or should she diversify by investing in several different business opportunities, maybe buying partial stakes in other people's ventures? Margaret chose concentration. She put her entire $8,000 into starting one cleaning business that she would personally run and control. She bought equipment, hired 2 part-time employees, and signed contracts with 3 small office buildings. For the first year, she worked 70-hour weeks, personally supervising every job, ensuring absolute quality, building relationships with every client. That business generated $15,000 in profit in year 2. In year 3, she expanded to 6 buildings and $35,000 in profit. By year 5, she was operating a company with 15 employees, 40 client buildings, and $150,000 in annual profit. 10 years after starting, Margaret sold that business for $800,000, turning her $8,000 into 100 times its initial value. Could she have achieved those returns by diversifying her $8,000 across partial investments in 4 different business ideas that other people would run? Absolutely not. The returns came specifically from her concentrated involvement, her personal expertise, her ability to ensure quality and build relationships directly. Concentration enabled success that diversification would have made impossible. Now you might be thinking, Milton, I'm not trying to start a business. I'm trying to invest my money. How does this apply to me? The principle applies exactly the same way. When you concentrate your investment capital and opportunities, you genuinely understand, whether that's a specific category of stocks, a particular type of real estate, a narrow industry segment, or any other investment domain. You create the conditions for exceptional returns that diversification across many areas you don't understand makes impossible. The question you should ask yourself isn't, am I properly diversified? The question should be, do I genuinely understand what I'm investing in well enough to justify concentrating my capital here? If the answer is yes, concentrate. If the answer is no, don't invest at all until you develop genuine understanding, the specific implementation strategy that turns $500 into substantial wealth. Let me tell you about the most important lesson I learned about building wealth from small amounts, and I learned it not from economics textbooks or academic research, but from watching my father-in-law operate his small clothing manufacturing business during the Great Depression. This principle, if you understand and implement it correctly, is more valuable than every portfolio theory, every market timing strategy, and every investment technique you'll ever learn. In 1934, at the absolute depths of the Depression, my father-in-law's business was barely surviving. Orders had dried up, credit was unavailable, and competitors were going bankrupt every week. He had saved about $1,200 in cash, a substantial sum when most people had nothing, and he faced a critical decision. The local textile supplier, a company he had worked with for years, was on the verge of bankruptcy and needed to liquidate their entire inventory of fabric immediately to raise cash. They offered my father-in-law the opportunity to buy $15,000 worth of high-quality fabric for just $1,200 in cash, 92 below normal wholesale prices, if he could take delivery within 1 week. The fabric was exactly the materials he needed for his manufacturing business, quality goods that he knew intimately from years of experience. Every one of my father-in-law's advisors and friends told him the same thing: don't do it. It's too risky. What if the depression continues and you can't sell the finished goods? What if customers don't return? What if you can't meet payroll? Keep your cash as safety reserves. He ignored all of them. He spent every dollar of his $1,200 savings on that fabric, leaving himself with zero cash reserves, completely concentrated in one massive bet. Then he worked day and night for 3 months, manufacturing the fabric into finished garments, personally visiting every potential customer he could find, offering reasonable prices and payment terms. Within 6 months, he had sold the finished products for $8,500 total revenue, with material costs of only $1,200. That's $7,300 in gross profit from a $1,200 investment in 6 months. He had generated a 608 return in 6 months by recognizing one spectacular opportunity in an area he understood completely and betting everything on it. That $7,300 in profit became the foundation that rebuilt his business and sustained our family through the rest of the Depression. And here's the critical lesson that applies directly to you and your $500 or $5 zero today. The opportunity existed precisely because conventional wisdom says you should never concentrate all your capital in one investment, that you should always keep cash reserves, that you should diversify to reduce risk. Following conventional wisdom would have meant my father-in-law earning maybe 2% interest on his $1,200 in a bank, about $24 per year, while his business slowly failed. Breaking conventional wisdom to concentrate everything in one opportunity he understood completely made him wealthy. Now let me give you the specific step-by-step framework that I would follow today if I were starting over with just $500 or $5,000, based on 40 years of studying market efficiency, price formation, and wealth creation. This is exactly what I told that Stanford student with $3,000, and it's what I tell my own grandchildren if they ask me how to invest small amounts today. Step one, and this is absolutely critical, choose one specific narrow market segment where you can develop genuine expertise that gives you informational advantage over other investors. And I mean narrow, not technology stocks or real estate or small businesses. Those categories are far too broad for anyone to master completely. Choose something much more specific. Maybe you work in healthcare, so you focus exclusively on medical device companies with revenues under $20 million in a specific therapeutic area you understand. Maybe you live in a college town, so you focus exclusively on student rental housing within 1 mile of campus. Maybe you're a software engineer, so you focus exclusively on small B2B software companies serving one specific industry vertical. Maybe you understand manufacturing, so you focus exclusively on small industrial distributors with specific customer profiles. The specific domain you choose matters less than choosing something narrow enough that you can realistically become the most knowledgeable person in your personal network about that specific area. Step two, spend the next 3 to 12 months minimum building genuine world-class expertise in your chosen narrow domain before you invest even $1. This step is where 95% of people fail before they even start because it's hard work with no immediate financial payoff, and honestly, it's pretty boring and tedious. But this is exactly where you're building the competitive advantage that will enable you to recognize genuinely mispriced opportunities when they appear. Read every book, every trade publication, every industry report, every blog post, every research paper you can find about your specific domain. Talk to every person you can find who works in that industry or invests in that space. Visit every business or property you can access in your domain. Build a detailed spreadsheet tracking every company, every transaction, every comparable sale, every market participant in your specific segment. Create your own database of information that nobody else has compiled. Most investors skip this step completely because they're impatient to put money to work, and that impatience guarantees mediocrity. When I was studying that printing business opportunity in 1964, I had already spent months analyzing dozens of similar small businesses, understanding typical profit margins, common failure modes, normal valuation ranges. When that specific opportunity appeared, I recognized it immediately as exceptional because I had developed genuine expertise in that narrow domain. Without that preparation, I would have passed right over it like everyone else did. Step three, and this requires enormous patience and discipline. Wait until you find one opportunity in your domain that meets very strict criteria. An opportunity where you have genuine informational advantage over other investors because of your specialized expertise. Where the price is obviously wrong based on your analysis and knowledge. Where you understand exactly why it's mispriced and what will correct that mispricing. Where you can articulate clearly what could go wrong and why you believe it won't. Do not compromise on these criteria just because you're anxious to invest. The worst investments, the investments that destroy capital and break people's spirits, happen when investors feel pressure to put money to work and settle for mediocre opportunities before they found something truly exceptional. This waiting period might take 3 months. It might take 6 months or a year or even 2 years. That's fine. Keep your money in treasury bills earning safe interest while you wait for the perfect opportunity. The young man with $3,000 that I advised at Stanford waited 11 months before he found his first investment. But when he found it, a small specialized software company that was dramatically undervalued, he made 87% profit in 14 months because he had waited for something truly exceptional. Step 4, when you finally find that perfect opportunity after patient searching, bet 25% to 50% of your total capital on it. Not 2%, not 5%, not 10%. I mean 25% to 50% of everything you have available. This will feel absolutely terrifying the first time you do it. Your hands will shake when you click the buy button. Your friends will tell you you're crazy. Your family will worry that you're gambling. Financial advisors will say you're violating every principle of prudent investing. Ignore all of them. If you've genuinely done the deep work I described, if you've built real expertise, if you've waited patiently, if the opportunity genuinely meets your strict criteria, then concentrating heavily is not reckless. It's the only rational choice. Every major fortune I've studied was built by people who recognized their few best opportunities and bet heavily on them with conviction. Small fortunes are built by people who spread their capital across dozens of mediocre ideas because they were afraid to commit meaningfully to anything. Now, here's the specific practical question you're probably asking, Milton. Where exactly do I find these opportunities? You keep talking about small businesses and specialized situations, but where do I actually look? Let me give you several specific hunting grounds that exist today in 2005. Places where individual investors with small capital still have genuine advantages over large institutions. First, look at microcap stocks trading on pink sheets or OTCBB with market capitalizations under $10 million. There are hundreds of these companies that generate real profits, have real customers, carry no debt, and trade at single-digit PE ratios because no institutional analyst covers them. Nobody at Fidelity or Vanguard can buy them because they're too small and illiquid. But you can spend 3 months researching one specific microcap company, calling their customers, visiting their facilities, understanding their business model completely. And if you find genuine value, you can build a position at prices that may stay irrational for months or years because there's no institutional capital to correct the mispricing. Second, look at small private businesses being sold by retiring baby boom generation owners. Over the next 10 to 20 years, millions of small business owners are going to retire, and many have no children interested in taking over their businesses. These businesses often sell for just 2 to 4 times cash flow to local buyers because there's no national market for them. No investment banks involved, no competitive bidding process. If you develop expertise in valuing small businesses in a specific industry, restaurants, dry cleaners, small manufacturing, distribution companies, you can find spectacular opportunities. Third, look at small-scale real estate in secondary and tertiary markets that institutional investors completely ignore. A small apartment building in a college town, a small commercial property in a growing suburb, a rental house near a major employer. These properties often trade at much lower cap rates and higher cash-on-cash returns than similar properties in major markets, simply because there's no institutional competition driving up prices. Fourth, look at specialized collectibles or assets where expertise creates enormous advantage. Rare books in specific categories, vintage cars or motorcycles of specific types, specialized antiques or art, industrial equipment, domain names in specific industries. These markets are completely inefficient because they require specialized knowledge to evaluate value. And most investors don't want to develop that specialized knowledge. Fifth, look at tax liens, judgment liens, and other specialized legal instruments that most investors don't understand. These can generate exceptional returns if you understand the legal mechanics and can evaluate the underlying assets. The specific opportunities change constantly, but the underlying principle never changes. Look where large institutions cannot or will not look because opportunities are too small, too specialized, too illiquid, or require too much specialized expertise. That's where small capital can still find genuine bargains. Step 5. Once you've made your concentrated investment, practice absolute patience while it works. This might take months, might take years, might take a decade. Don't check prices daily. Don't panic during inevitable market corrections. Don't sell just because something has appreciated 20% and you want to lock in gains. If you bought genuine quality at reasonable prices after doing serious work, time becomes your friend and patience becomes your competitive advantage. Let me close with the most important insight I can possibly share with you about investing small amounts. And this comes from 40 years of studying wealth creation across thousands of individuals. The people who build serious life-changing wealth starting from small amounts all follow the same pattern without exception. They develop deep expertise in one narrow specific area. They wait patiently for genuinely outstanding opportunities in that area. They bet heavily when those rare opportunities appear, and they hold for years while their investments compound. The people who stay poor or build wealth slowly do the exact opposite. They spread themselves across many areas they don't really understand. They chase tips and trends. They make tiny token bets on everything so nothing matters. And they panic and sell during corrections. Your $505,000 today is genuinely more valuable than $5 million for building wealth because you still have access to all those inefficient markets, all those concentrated positions, all those big swings on compelling opportunities. Don't waste that advantage by pretending you're a pension fund. You're not an institution managing billions. You're small. And being small is your superpower if you understand how to use it correctly. Everything I've shared today is based on rigorous economic analysis and decades of real-world observation. Now the question is, will you implement it, or will you keep following conventional advice designed for people in completely different financial situations? The choice is yours, and that choice will determine your entire financial future. Start today by choosing your narrow domain of expertise. Spend the next several months building genuine knowledge. Wait patiently for your first exceptional opportunity. And when you find it, bet heavily with conviction. That's how you turn $500 into substantial wealth. And that's how every significant fortune in history was built. Now go out there and take action, because knowledge without implementation is just expensive entertainment.